Palantir's earnings are coming out tomorrow. Just like everyone else, I'm curious to know how the company performed for the first quarter of 2024. Now, I'll go over my personal take on what three-ish things will make me happy as an individual investor when the earnings come out. Note, I already made a video last week on the big metrics I'm looking out for, so check that out after if you've missed it, but this video will be really focused on the main things that I will say will make or break a successful quarter for Palantir, in my own opinion, of course, so we'll dive right in. Now, first of the three pieces is their GAAP operational income. And I know I sound like a broken record, but first, GAAP net income, which will include interest income, is cool and all and great for S&P index eligibility. But that's honestly just the cherry on top, which when it happens, it will. Can be in the upcoming quarter or even later. But GAAP operational income is what I really care about with them consistently expanding. As I've emphasized in the past, GAAP operational income is the true scorecard of profitability when it comes to making money with running their business. And I'm always showing this graph showing they recently achieved the positive milestone in Q1 of 2023, which is one quarter later than their first positive GAAP net income in Q4 2022, mainly pushed by the stepped up basis. So at the time, some folks didn't know if they'd actually be able to consistently deliver until I saw this start to go positive. Now, for a quick crash course here, what are the mechanics of GAAP operational income? This will help with understanding the results when they're out to see what is driving its increase, decrease, or stagnation. So if we go to Palantir's condensed consolidated statements of operations from last quarter, you can see in the middle income or loss from operations here with that $65.8 million that we saw. And quick note, everything with a 1 has the cost of stock-based compensation already included, so that is being taken into account. Now, when they bring in revenue, that's the cost of revenue as well. So what is directly the cost of creating, delivering the product and or services to the customers? And if you think of a SaaS company specifically, this could be like hosting fees, service cloud, web development, maintenance, licensing, all those stuff. You get the gist. So that's just how much is attributed to the revenue that they're bringing in. Now, logically, you always want a positive gross profit or else it'll cost you money to even just do business. But with tech unicorns that are not public or just recently public, this can be the case actually. Now, not for Palantir, obviously, in their stage of life currently, and ideally this is a healthy margin, or in this case, calculated gross margin for 2022 was 78.5%, while 2023 actually went up to 80%. But these are the kinds of levels you want to see with a software company. Now, further trickling down to get to operating income, we still need to remove our operating expenses. So first, sales and marketing, which increased around $42 million from 2022 to 2023. But that makes sense with their push for AIP boot camps, AIPCon events all over essentially, just to spread the word about their products. And I'd say Palantir has been pretty prudent, honestly. Yes, they increased spending here, but definitely not breaking the bank. Then for R&D or research and development, we have increased around $45 million also, which I'm okay with as long as it's the same as above, responsible and within the means of the company. So I understand dollars need to be spent to maintain and grow your technological moat, but if you've been good about innovation consistently, or if you're just very good at it in general, if you see a massive dump here for a company, it might be a signal of trying to play catch up, or it could be a quick band-aid to create the next best thing if they have to spend a lot on R&D, but there's still the risk of failure to ever catch up and just bleeding money. And if it's the opposite direction where they just cut all the R&D, they might just be falling behind and giving up because they just can't spend anymore. So like anything, you have to understand when to throw the cash at R&D. Now, what really helps allow this, and I'd say really offset the increases we saw for the previous two categories, is G&A or general administrative expenses. This went down actually $72 million from 2022 to 2023. If you think of G&A at a company, it's really just to run the company. There will always be some level of it, of course, but some organizations can get so bloated that G&A can be an issue and require layoffs. It can sometimes turn into a black box of expenses that could hide redundancies and efficiencies, but even if there were reviews of perks getting cut from Palantir offices like food and such, that would also fall into here. So I'd say that's a smaller part though, but does get bucketed as well. So that's where we get to the operational income. So they were able to flip this around because they brought in more revenue at a healthy gross margin, but also minimize the increases in their operational expenses mainly, but still investing in their sales and marketing and R&D, but slimming down that G&A expense. Now, the bonus benefit of this positive operational income for Palantir is that the interest income now is just gravy on top and not really relied upon for them to keep their GAAP profitability, which I alluded to at the beginning. So we spend a lot of time on operational income because it truly is important. But the other crucial point for a successful quarter, and I'd say a bigger driver truly in justifying their valuation, growing customer counts and revenue. And I know it's not some secret and it's super obvious, but why is it so crucial we need customer counts and revenue to actually grow as a bigger company? Well, first of all, if you're trading at $50 billion and you're at $2 to $3 billion in just revenue, and still kudos for being profitable, of course, but it'll take many years to make it a worthwhile pretty penny spent on them. Hence, while you've got the margin mastered and down here at 80%, we just got to get more dollars at the top line to feed the money making machine Palantir is. But do remember, it's trading at this valuation because there are growth expectations. Now, customer counts and revenue are the key to a successful quarter, as I said, because if we actually start to see a bump from AIP and customer counts and not necessarily in revenue, at least we have something to hold on to as something coming down the pipeline eventually, especially since qualitatively we know about the stickiness and ability for Palantir to expand their offerings for existing customers. Now, if customer count isn't an amazing bump and it'd be a bummer, but if we're able to get more revenue than expected, then that's still fine. But ideally, we can see both improving from their bootcamp strategy. The real killer here is, though, if we don't see any bump at all. The importance for this quarter is that basically it's been building the past 6 months, the disconnect between the numbers and management's excitement about the bootcamp strategy. And that just compounds on the expectations that eventually we want to see scaling from not only the number of bootcamps, which we've seen, but customer count and then eventually revenue. And I think this has been building up over the last quarter, considering AIP has been out for a year now, with the bootcamp strategy getting some momentum the last 6 months and being highly advertised as their main tool to push customer adoption. And that's where we land on the third piece. We've only been talking about performance and what results they'll disclose, but sometimes even bad results can be offset by a very positive outlook given by management. Say we don't even see a bump in customer count or revenue, but for some odd reason, they just raise guidance like crazy because they know they'll hit it out of the park one more quarter out or just for the full year of 2024. So regardless of the first two, there can still be a very positive reaction because management is essentially telling us things are going to be good. Now, that means they'll actually have to deliver on that eventually, but with that short-term mindedness and forward-looking pricing for equities, then it wouldn't be surprising to see excitement around any positive revision to guidance. And to be clear, I'm talking about actually raising guidance officially, and not like if they keep guidance the same and talk it up during the earnings call about how much growth they're expecting. I wouldn't like to count on it unless it's on the official scorecard. So there's obviously a combination of these different metrics that can create different or the same outcomes, and ideally all of them are positively impacted in the next report. Now, we don't know the numbers yet for Palantir, but long-term wise, the first piece of GAAP operational profit is crucial to the longevity and survivability of the company. Even if growth stagnates or slows down, we know they would not go bankrupt at all, but that's just the bare minimum. To really be a company growing into its valuation, it has to deliver and bring in customers to the top line. Because an awesome money machine with 80% gross margins is only a percentage. I'd rather have, say, 75% of $10 billion than 80% of $3 billion. And then the narrative that Palantir's management has to share with guidance, they could just keep it exactly the same, which isn't amazing, but isn't the worst thing to happen. But if they have the inclination for a positive revision, then that could be a crutch for the numbers that are still lagging the true growth they may be seeing themselves directly with customers. But let me know your thoughts below on all this, and I'll see you in the next video.